Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Second point is they haven't wanted to move in their currency because they look at Japan, and if you think of Japan in 1989, when they had a big credit drive up and their currency went, all their stocks went up and they were taking over the world. Prior to 1989, before the bubble burst in Japan, the G7 countries got together and pushed the value of the Japanese yen up effectively. They called it the Plaza Accord, and they said it was because the U.S. dollar was too high, but implicitly it was purely to try and hurt Japan and push their currency up in value. So China looks at that and says, the West has done this, to us once before. Japan had this basically the same policy of beggar thy neighbor export. They do to a degree, but their currency has appreciated tremendously, so they can't play that game the way China is doing it. So China said, we're not going to allow that, so we're going to maintain our peg. So there's a couple, a policy standpoint, which they've seen some history here that they're afraid of. They have an export-driven economy, so they want to maintain that currency competitiveness to drive more and more exports, because that is the key for them still. They just don't have the internal demand to do it. And number three, social control. Social control has another subsidiary consequence. The reason they have capital controls on their citizens is it allows them to, and have very artificially low interest rates in the country. It basically forces savings and forces money into bank accounts and allows more accumulation of domestic credit for the industry to use to build more and more and deeper manufacturing and more infrastructure. So it goes hand in hand. The forced savings is part of the whole capital controls in China. So this is a policy that's embedded, and these people that years ago said, well, China's just going to, we're going to wake up one day and they're going to, their currency is going to be up 20-30%. I think really missed the point, the key point, if they would have understood the deeper policy objectives of China and the structure of the system. But ultimately, the growth is there, the money is there. Everybody wants to manufacture in China. In fact, there's a quid pro quo for manufacturing in China. If you want some type of access or pretend access to their markets, they force you to manufacture there, unlike other countries in the world where you can pretty much manufacture elsewhere and ship goods into the country and distribute them. China pretty much forces most manufacturers to not only manufacture there, but also build up a local competitor, a partner with another Chinese firm, basically transferring all the technology to the Chinese firm, which ultimately one day will put you out of business. It's a very odd thing, but the manufacturers in the U.S. and globally know exactly what the rules are, and they've chosen to play. And China gets a lot of free inherent manufacturing technology transferred to them because of this idea of ultimately access to these billions of consumers. And as I said, it's very, very good for China, very bad most of the time for the second-tier manufacturers. The big manufacturers, of course, get treated pretty well because they're the PR machines. But this is kind of the game that has gone on, and that's another reason we've seen more and more real property investments in China. You have to get in there to manufacture to try and get access to this growing base of, a potentially base, and we'll show you that, of customers that are huge. The other thing is the Asian bloc currencies, because of China's policies, have been suppressed, and I'll show you that in just a second. And of course, the U.S. dollar sentiment is very much driven by China's view on the treasuries, because this policy in which China has to peg their currency to the U.S., it forces and creates a lot of liquidity for them. Pegging their currency, and I won't get into this, but technically it creates and forces them to buy U.S. treasuries in the process of doing this. And that's another thing that can change dramatically if the policy changes. Just to look at in terms of relative sizes of the economy, China really is a $4.2 trillion economy. You can see that there. But on these, what they consider purchasing power parity back in 2008, it's the second largest economy in the world. This assumes, obviously, a revaluation of the Chinese currency based on this purchasing power. So you can see that the estimates of what China is nominally of 4.2 trillion compared to the purchasing power basis, the currency is extremely undervalued. Most estimates range from 40 to 60% undervaluation of the currency, and it makes sense. I mean, if you look at, for example, something like Brazil, since 2002, I think the currency has appreciated like 90% against the U.S. dollar. I think China's gone up about 12 or 13%. And you look at the relative growth in China, even compared to Brazil, which has been tremendous. China dwarfs them, and yet their currency hasn't moved. So any way you slice this, and in any way you look at the numbers, China's currency is undervalued. So this idea, or this talk that you get from economists out there, which are usually just mouthpieces for, so-called free market trade, unquote, that say it's not a currency situation and China's currency is not, undervalued. It's really just ridiculous. It's total hogwash. It's extremely undervalued. U.S., China, in terms of this purchasing power, second, and growing very, very fast. But what you also have to remember is the U.S., from a capital market standpoint, still dwarfs China in terms of capital markets, and that's a big driver of support for the U.S. dollar still, and we'll get into that a little bit. But just wanted to give you an idea of the relative size there of the economy, 4.2 trillion, you think of it. U.S. is still, 3 times larger than China's economy on that basis. And from a individual per capita income basis, the U.S. dwarfs China in a very, very big way. I think China is around 2,000, the U.S. like over 40,000 per capita, so a long way to go on a per capita basis. This is where, if you think of this strategically, from a broader macro standpoint, and this applies really to all emerging markets, but very much so for China because of the massive amount of people that they have. What this chart shows, and this is from a company called GavCal, is that as you move down this path from agriculture to industry and then to services, it unleashes value for your economy and creates wealth. It's just a natural process of migration as this happens when you go from just out in the field into the factory and then start upgrading that to even deeper and deeper value-added services. And you look at this path, and China isn't very far along here, and a lot of the other emerging market economies aren't. As they move down this path, where the Western nations have moved down this path pretty far from a migration standpoint, from a pure productivity standpoint in terms of labor, they don't have much further to go, where these other countries have so much more that they can squeeze out just from this natural process if the growth in the global economy continues. And as you move down this path, another thing is, and if you look at the chart, it shows volatility on the y-axis and growth on the x-axis. So as you move down this path away from agriculture into services, not only does your wealth increase, but the volatility in your economy decreases. And if ultimately China is going to be the major driver in terms of demand in the world as they move down this path and unleash their consumers, you're going to see, in effect, the risk will decline in terms of growth. Now, not to say we're going to denute business cycles. We've never have, and they always will be, I think, in any type of quasi-free market system. But in general, when we see a big economy like that, as it moves down this path, it ultimately has the potential to reduce volatility in the global economy as China continues to migrate down here and normalizes as an economy as we go further.
Thank you for participating in this week's session. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.